So, hi everyone. This is Typhon Capital Management's Q3 recap and Q4 outlook call. We're joined with most of our portfolio managers coming from west to east, LA, Chicago, New York, and London. Q3 was a pretty good quarter for us, and Q4 is off to a pretty good start as well. So, got a lot to share with you, and just have to advise that this call is being recorded, so if you don't want your voice potentially recorded, please disconnect now. Also, Typhon Capital Management only provides advice to qualified eligible participants for our future strategies and accredited investors on the security side. So if those disclaimers do not fit for you, also please don't watch this. We're going to start off with our CIO, Dave Klusendorf, and then move on to our PMs. Dave? Who I need to unmute. Dave.
Thanks. There you go. Typhon's coming off. They're a real strong month, as James has mentioned. For Vulcan, this is the 7th straight month in a row that the Vulcan Metals Fund has posted a gain. The Proteus dynamic volatility strategy has now posted gains 9 out of the last 10 months. So we've really been off to a good year so far going into the last quarter. I'd like to start with for coming on board. We talked about the U.S. Reserve quietly nudging rates down to, above the 2% level, and Japan at the 0. So when you have this action by, the big federal banks, what do you see the impact on the FX market? You got Nick unmuted?
He should be. Actually, he might have gotten disconnected. I don't see his number on here.
Yeah, I don't see it either.
Oh, he's back. Here, let me unmute him. Clue, could you repeat the question for Nick?
Yeah, I'm back.
You bet. Nick, we've been talking a little bit about the Fed nudging rates here in the States above 2%. Japan's rates still at 0. What effect do you see that on the FX market?
Well, I think the Fed's trying to manage expectations at this point, because ultimately things will change. Everyone talks about lower for longer, but as long as that is the case, and people's expectation is that that is the case, when things change, it will be a massive shock. So I think, as I say, it's about expectations and managing those. But FX markets are really pretty tough at the moment, specifically for our strategy. I mean, vol is getting completely crushed. G10 pairs are not following the script as far as the usual price drivers are concerned. So those would be rate differentials, relative curve slope, inflation expectations, and so forth. And they're relevant from one day to the next, but then the market decides that they're not relevant anymore. And rather than that, it seems to have decided that certain currencies are risk-on currencies and certain currencies are risk-off currencies. So you can have days when dollar is up against the Canadian dollar but down against the yen, the same against cable, same against the euro. So it's really tough. It's really mixed at the moment. So things are driven more these days by headlines. So one day it will be a Brexit negotiation problem, the next will be North Korea, the next will be a Trump tweet, or all of them at the same time. And those are the drivers of price action at the moment. So directionality at this point is extremely short-lived. And for us, that isn't really great. So as long as inflation, I think inflation is the real key here. As long as inflation is muted and global liquidity is still high, which it is right now, that should keep the dollar better offered, at least for the short term. And that's particularly against emerging market currencies, which we don't trade, obviously. We trade G10 only. So unless US inflation picks up, that's going to remain the case. So for at least the time being, we just have to be patient and let the strategy's risk models keep us out of big trouble until a clearer picture emerges on global rate trajectory, and then hopefully consistent price direction will follow that. But my personal view is that no one is currently willing to push the button. Everyone is frightened that we're going to get back to a 1932 situation where the Fed raised rates too quick after the 1929 problem, and it just leads for a very fragile market. There's nothing really to hold you in a position right now. There are no really steep curves. There are no carry trades of any substance that can give any consistency to a run. So right now it's really tough. It's really tough for us, and I think that will change. I don't know when it'll change, but we just have to stay in the game. And as I say, the risk models are what keeping us in right now.
Sorry, Cliff. It muted you when you got disconnected there.
Thanks, Nick. Appreciate it. I'd like to move on to the James Gallo, who heads up our Vulcan's Metals fund and strategy. James, always good to have you. James is on the phone, so there's no video for James.
James, can I be really, really, really rude? I need to hop off this call because I need to do some data downloads right now.
You got it, Nick.
Guys, is that okay?
Yep.
Have a good night. Cheerio.
We'll speak soon.
James, can we talk a little bit about this rise up in copper this month that we've seen?
We sure can. Big part of it was overnight movement. What we had, the reason for our overnight rally was China data coming out, PPI numbers coming out up at a 6.9 as opposed to 6.4, kind of continued the rally. We're also starting to hear some buzz, of perhaps some consumers being under hedged and, in other words, not buying enough copper for their needs previously. Tend to late in the year, a lot of people's business is already done. This seems to be a late year situation where it might have got a little sticky for a few consumers. So we're seeing that on our end. One of the interesting things of the rally in this market, where usually we will see our front ends much higher naturally if there is a real need for physical copper, and we continue to not see this. Just this week, Macquarie came out, said they are no longer putting any quote-unquote financing money into their metals complex. Instead, they see better returns in the energy sector. So we have been seeing these banks and other groups pull out of financing. So we're definitely looking at a new dynamic to these markets where the fundamentals just don't mean as much on the fiscal end. The price is what it is, and we are seeing a huge amount of continued speculative open interest. Just to give a brief overview, just in copper, we had a 340,000 contract high a couple of months ago, and we dipped that into the 290s. We're back up today. I'd like to see we'll probably be up around 10,000. So what we're seeing is what it seems to be is all new Chinese buying coming in. They came in, unfortunately for them, on the higher end, stopped out on the lower end. So it looks like they're going to give it another try on the speculative side. Also, as I said, we do have some consumers that may be trapped a little bit, but we're not seeing that on the physical side at all. So some good reasons for the run up. Really not a huge believer in it until we see the spreads tighten and the signs of a traditional bull market. So that's where we stand right now. But we're also doing some additional studies on this different paradigm in the market that may be coming in play where, without all these banks and everyone else financing metal, and we've definitely seen that from U.S. banks, Australian banks, and we've definitely seen a huge curbing of that tactic in China for sure. where we may be looking at a new paradigm where that really doesn't matter as much for a bull run. Right now, we are cautiously bearish, but open to further discussions as we continue our studies into this new market paradigm.
Thanks, James. Really appreciate it. Does anyone have any questions for James?
Everyone's muted, so they can't really ask questions. We can hold all the questions till the end.
Okay. All right. Well, as long as we kind of had a nice little segue into energy, why don't we bring George on board? And George can talk a little bit about the tug of war in the energy sector and, then this low vol environment on the macro side. George, good to hear from you today.
Thanks again for listening to my ranting preemptively. But on the energy side, it's sort of the continued tug of war between TI and Brent. My position right now is to be short the TI spreads versus long the Brent spreads. It's my view that both reflects the fundamentals in each market and also sort of gives a free option, but a lopsided upside to any geopolitical risk that might break out in the Middle East as things get a little bit more tense there. And we'll see, I think, ultimately this result in a fairly large price move, which will be led through the spreads first, unless it's an event, and then they'll go together. But while I'm sort of waiting for that clear directional trend, I'm playing everything through the ARBs into spreads, which I think will continue to show Brent strength over TI. And again, Brent, TI, ARB boxes are the best way to play that. And that means long front in Brent and short the back in Brent. Now, when it comes to macro, it's obviously, it's a very, very difficult environment. The main theme is really divergence. I think you were touching on it earlier between the central banks, the US now, sort of playing chicken with the market in terms of quantitative tightening. And then, of course, potentially the ECB near a pivot point and starting to potentially make their program smaller. We'll see at the end of the month what happens. And Japan seems to be in a perpetual QE commitment mode. But you would expect the currencies to be reflecting this with relative strength in the dollar compared to the other G10 currencies. And that's simply not happening. I think there's multiple reasons for that. I think one of them is we are coinciding. And by the way, I may have gone beyond the scope of your question. I apologize. But this is what's interesting, I think, right now. But I think what's happening is the risk-on environment and repatriation of money that gone into the US dollar back into higher returning markets in Europe and Japan might be keeping those currencies relatively strong despite the policy divergence in the central bank, combined with, I think, a treasury that seems committed to low dollar via Trump and policy. Who knows exactly what the mechanical effects, if any, are that. There's long been conspiracy theories about intervention. I don't know if that's true or not. I think the market dynamic alone is enough to explain potentially why we're not seeing the dollar being stronger relative to those currencies, particularly the yen. But I think those effects will ultimately be temporary. What really needs to happen, however, is the market needs to believe, because it's been trained for so long, that the central banking threat for tightening is either a bluff or it doesn't matter. Markets will continue to go up and risk needs to be pursued. Once you actually see the mechanical tightening happening and the market has no choice but to observe what happens when liquidity is removed, then I think you're going to actually see a shock where the dollar and the old rules between currency pairs reassert themselves. Because right now it's just words and it's a reality to deal with in the future. Once that reality is here and dollars are being removed from the global financial system, and the opposite is happening from a liquidity perspective with especially the yen, I think that will be the wake-up call. And that could be sort of the bell that rings for the rest of the macro markets and takes us out of, coming full circle to your original question, the low vol regime in currencies and the macro space in general. So that's really what I'm looking for, it's all about that story to me in macro space. That's all I care about right now.
Thanks, George. Appreciate it. Well, that's a great topic to switch over to Matt and Mike Thompson.
Hi, Clue.
What's going on, fellas? Can we talk about a couple topics then on the volatility side? Matt and Mike run the Proteus Dynamic Volatility Program. That's really consistent returns over the last 11 months now. We talk a little bit about that happening for the program, along with this wonderful low vol environment we find ourselves in, and some of the things that are influencing that and some of the measures.
Yeah, so obviously this year has just been crazy low volatility. I mean, VIX, the VIX index has spent basically all of October under 10, which, to put it in perspective, I think it maybe closed under 10 one or two times since 1990, and it's spent every day in October under 10. I mean, there's been, rather than me just talk through it, I've got a couple slides here I can just show to kind of give you what clue you're sharing there. So
it should actually work if I.
Yeah, it's just saying you can't start screen share while the other participant is sharing.
Really?
Yeah. It's fine. If it's easier, I can just talk through it too.
Okay. Try now.
Share screen. There we go. Can you see it?
Yep.
All right, great. So just real quickly, I won't belabor the point, but so super low vol environment this year. I mean, this is historically low vol. The reason VIX is so low is because the S&P hasn't moved very much. Realized vol is way down, and in fact, almost historical lows going back to the 20s. So this is the number of days with at least a 1% move up or down in the S&P. I mean, you're talking going all the way back to 1960. That was the last time you saw something like this. And we got another range type chart. This goes back to 1970. The prior month's range, percent high to low, 35 bit prior month range, most recent print, which is all-time low on this chart. Just crazy. Maximum intra-year drawdown. So the biggest drawdown, peak to trough, we've had in the S&P this year is 2.8%. That's crazy low, second all-time, going back to 1928. And then this is just the same idea. This is each shaded bar here is a 2% down day in the S&P. And the last one we saw, I think this is maybe in August. We've seen maybe 2 this year. It's just been unbelievably smooth sailing that keeps the VIX super low in the context of a steep VIX futures curve. You just have this consistent decay that's happening in the VIX futures with no hiccups along the way, and that's where that consistency is coming from in our returns. We've stayed consistently positioned to pick up that decay with some defensive type positions for the spike that never comes so far this year, hence our consistency.
Let's talk a little bit about those defensive positions. So how do you best go about making sure that the guy doesn't go around you and make you a poster child by dunking it over you?
Our favorite position for these types of low vol environments is basically calendar ratios. So an example would be long the front month and then short more contracts in the deferred months. So we can be true to the signal, the roll down signal, but be long kind of reactivity or the gamma-like qualities of the VIX futures. So that would be probably the most common position we've had on lately. Is a 1x2 or a 1x3, and then move that around as a function of time, basically. So it keeps us defensive and profitable, which makes for an easier sleep at night type of position.
Gotcha. Well, thanks for sharing with us, Mike and Matt. Really appreciate it. That's the question everyone asks now is when this low vol environment is going to end. So,
yeah, let me get the crystal ball out. I think we know that we're at the bottom end of this cycle. VIX doesn't get any lower than this. I mean, maybe it can scrape a little bit lower for a while, but we know what's on the other side of this is a bear market in stocks and 40s and 50s again in the VIX. And we think that's really the hidden gem in our strategy is that that type of environment is very profitable for us as well. If vol wants to be high and stay high, that's great for us too. It's managing the transitions is really where the secret sauce is, and where the rubber meets the road. Once we get into a trend, high or low, we should be able to make some money here. So we're looking forward to seeing the other side when it's not so easy everywhere else.
Gotcha. Thanks. Appreciate it.
Thanks. Thank you.
Did I see Damien flash on?
He did.
Yeah. Good to see you, Damien. Welcome.
Hey, how's it going? Can you hear me there, guys?
You bet.
Cool. Sorry. Yeah, so sorry. I've had big IT issues trying to get in. But anyway, I'm now in. So I've missed what's gone on ahead. So apologies on that. But do you want me to run through anything?
Yeah. Well, why don't we just start over the last couple of months? The program's done well. Can we talk a little bit about that and how it's able to accomplish that with, a lower risk than the general market?
Sorry. Yeah. I mean, it's as I caught the end of that call, we'd like a bit more volatility, obviously. The program hasn't been designed to specifically, hunt for volatility. Given we only trade one product, we are slightly at the whim of the sort of underlying vol in that. But the model is designed; it's looking to try and pick up shapes of a move rather than trends of a move. So actually, there can be times, even in low vol, as we've seen in the last couple of months, where even though we're trading quite close to our signal line, we can actually things can pan out our way, and hopefully it's a presage of a bit more vol to come. If our performance is picking up, that might be a slight indicator that things could be about to turn. Difficult to tell, really, but it's been satisfying for us that we've sort of come out slightly out of the doldrums. Not that we've had a tricky year, we just sort of flatlined, as a lot of people have, bumping along the zero line. So nice to get into positive territory, and hopefully we'll see more to come.
So, do you see anything on the horizon from your point of view that could be a sharp snap out of a low vol environment?
It's not really, if I'm brutally honest. I mean, I think people are looking at the dollar. Obviously, the euro strength is slightly helping the weakness in the DAX, or causing a bit of weakness in the DAX. I think if anyone knew where it's vol is like that, it will come from something that's completely unexpected. So, I mean, I'd love to say yes, that there are things that are. I mean, last week, I think it was the week before, this Catalonia stuff has been interesting over in Spain. There was a bit of a wobble in the Spanish market, although that bounced back quite fast. So there's definite issues in Europe, as everyone's well aware of, and it's investors seem to be ignoring them for the time being. But I think that you could run into a perfect storm of a few more Italian banks going under and Catalonia rattling harder. And people might go, actually, it's time to take some money off the table. So, will there be a specific trigger? I'm sure there will, but it's very hard to see where it's going to come from.
Thanks, Damien. I really appreciate it.
No worries, Cleve. Sorry for being so late.
No worries. James, do you want to handle questions and answers?
I don't think we need to take questions today. So just, Clue, if you got any final thoughts, wrap it up, and just thank everyone for joining.
My final thought really revolves around Typhon. We've really done a good job of constructing and everyone buying into a well-designed risk parameters for each of the programs. And it's really starting to shine here in 2017, where you're starting to see good, consistent returns, a good grinding nature to everything. And I think it's something that, we've all are delighted in, that is happened for us. So there's my thought coming in at the October level here at the end of the year. I don't want to jinx anything, so I'm knocking on wood or fake wood on the desk. And let's just keep plowing forward.
Yeah, and thanks to Clue for kind of spearheading our whole risk management program. He's done a great job. And thanks to our PMs, especially like the two that manage video. Like, I know it's a high bar, guys. We the great hoodie, Matt. Like, just overachievers through and through. But anyway, thank you everyone for joining us. It's always a pleasure. And I guess we'll talk to you probably early next year for our Q4 end of the year recap. Thanks a lot. Have a good one.
Thanks, guys.